Hey guys, Tony here. Good morning. So GameStop is, well, yeah, I'd say rallying, right? It's pushing pretty hard to the upside. It's at 234. Unfortunately, I really only have one share in case of MOAS. So I did have two calls, for pretty out of the money. I think there were 280s that actually ended up expiring last week, right? Yeah, right there, November 19th. So this is a good lesson on why you do not buy weeklies or why you do not buy YOLOs, right? If I would have just stuck to my original strategy, which is always buy at least a month out, I would have been able to catch this pump from 207 that we had last Friday up until the pump that more than likely GameStop is going to open above 230. And you know, a run from essentially $200 to 230 is actually pretty significant, right? So it's definitely, you know, a big run on GameStop's part. And if I would have bought out, you know, a month calls, I would have more than likely had them expire not this week but next week, right? So I would have been able to hold those two calls for an extra, you know, 2 weeks, which is definitely a lot better than having them expire worthless last week. So, you know, this kind of gives you a good understanding of why weeklies and YOLOs are such a bad idea. And even if you do have, you know, a target price of, say, you know, 250 on GameStop or 200, whatever, right? If you think, oh, you know what, I think GameStop's gonna hit 250 in 2 weeks, you should still buy a monthly call to give yourself that extra wiggle room, that extra time in case it takes a little bit longer to get there. Or in the case of like Tesla, where you're like, oh, you know what, I think Tesla's gonna hit $1,000 in a month. Buy a 2 month out call. Instead of buying like 2 or 3 monthlies, buy one that's 2 months out. I know they're a little bit more expensive, and it's kind of, maybe it might be a bad example, but remember, it's always better to buy time on options because they are super prone to time decay, right? And when it comes to IV and premium, you know, a run like this can significantly increase the price of an option in a day or two, even if you are down 60, 70, 80, 90%. You know, if you had a call for like 230 and all you were doing is, you know, holding, and one day, boom, you basically run up to your strike price, you know, you essentially just have a call that's not worth maybe 100 or 200% more, which is insane, right? So, you know, big lesson to anybody: if you have an ideal strike that you think a ticker is going to be to or is going to go to in, say, 2 weeks, buy extra time, right? Always buy time. If you're planning on buying, you know, 2 to 3, 4 calls for 2 weeks, buy 1 call or 2 calls for a month out. Give yourself that extra time. Give yourself that wiggle room. I'll see you guys later. Bye-bye.